Alright, so this presentation will briefly describe the history of the banking system and specifically how a two-part banking system leads to a potential for crisis, and in this presentation we'll examine in depth the 2008 recession, the factors leading up to it, the aftermath, and how we can prevent the same mistake moving forward. Alright, so banks have been around since the first currencies were minted. It was actually temples served as the first banks in ancient times because people looked to priests and monks as the most honest in society. And it was the Romans who built the first institution that became widely known as a bank. And then in the 1700s, it was mainly due to Adam Smith propagating his ideas about the invisible hand theory that led to limiting government roles in banks. The controversy over charting a central bank arose from the opposition that many of the forefathers of America had due to the fact that England tried to place the colonies under the monetary control of the Bank of England, and this was a spark that really led to the Revolutionary War. But it was Robert Morris, who was the superintendent of finance at the time, who really pushed for the central banking system, and he's now widely known as the forefather of our system of credit and paper circulation in the U.S. The National Bank Act of 1863 was used to implement a national currency, and its primary use was to float federal war loans during the Civil War because how expensive it was for the North to fight against the South. And it was President Wilson who created the Federal Reserve System that we now have to create a more stable and flexible monetary. Now, the Federal Reserve really serves four main purposes, as outlined here, but we'll go into a little bit more depth. The first purpose is conducting the nation's monetary policy by influencing money and credit conditions in the economy in pursuit of full employment and stable prices, so getting as close as we can to equilibrium. The second is supervising and regulating banks and other important financial institutions to ensure the safety and soundness of the nation's banking and financial system and to protect the credit rights of consumers. The third is maintaining the stability of the financial system and containing systemic risks that may arise in financial markets. So really regulating the banking system so that we don't fall into a crisis, but that hasn't been the case, in the history of the U.S., obviously. The fourth is providing certain financial services to the U.S. government, U.S. financial institutions, and foreign official institutions, and playing a major role in operating and overseeing the nation's payment systems. Indirectly, the creation of the Fed actually led to a two-part banking system in the U.S. The second part is known as shadow banking. Now, financial innovations are driven by the desire to earn profits in the capitalistic society that we live in. So this is where shadow banking comes into play. Now, shadow banking are these different innovations such as hedge funds, money market funds, structured investment vehicles, credit investment funds, exchange-traded funds, etc., and the majority of these banking institutions are not regulated by the central banking system. So we really have this two-part banking system going on in the U.S. One that is heavily regulated by the Fed, and one that doesn't succumb to these same regulations because it's being created as new innovations are arising. Shadow banking institutions usually do not have a banking license. They do not take deposits, and they can increase their profits on investment by leveraging mainstream counterparts and therefore avoiding rules to prevent financial crises that the Fed has in place. And shadow banking makes up approximately 30% of the financial industry and is worth an estimated $60 trillion and played a large factor in the 2008 recession. If you look to the very popular movie The Wolf of Wall Street, where, they were selling these pink slip stocks at extremely huge quantities and then making, I think, 50%. The brokers were bringing in 50% in commission. that would be considered shadow banking, where they're operating in this very gray area legally wise. Alright, now I want to get into the 2008 recession, now that we understand the two-part banking system in the U.S., one that is heavily regulated and guaranteed by the Fed, and the other one that operates in this land of gray legality. Now, before we get into the factors of the 2008 recession, what led up to it, I just want to give a little bit of background to the 2008 recession. So the 2008 recession was coined the Great Recession and is widely known as the greatest economic downturn in American history since the Great Depression at the end of the 20s. Now let's define the word recession so we're all on the same page. Recession is defined as 2 or more consecutive quarters with a negative GDP growth. The U.S. has actually had 47 recessions since 1785, with most of them only lasting 3 or 2 quarters. The Great Recession lasted for 1 year and 6 months, so that's 6 quarters, with an overall decline of GDP by 4.3% and a peak unemployment rate of 10%. Now, comparatively, the Great Depression had a peak unemployment rate of 24.9% and decline in GDP by 26.7%. The recession after World War II also had a dramatic negative effect on the economy. But what's interesting about the 2008 recession was how quickly things started to dip. But shouldn't we have learned from these mistakes in the past? I mean, especially if this is our 47th recession. So let's examine on a closer level what factors led up to the recession of 2008. Alright, so what was going on with banks in the years prior to 2008? Well, what we need to understand is that banks make money by giving out loans and charging an interest rate that is higher than the interest rate that they are giving to people who are keeping their deposits in their banks, in their savings and checkings account. And what a lot of people don't know is that we operate on a fractional reserve system, and that means that banks only need to have 10% in reserves on the loan it makes. So to keep things simple, if a bank wants to give a $100 loan, it only needs to have $10 in reserves. And this seems counterintuitive because then there's really nothing to stop lending from spiraling out of control, where banks are basically operating way past their means at all times. And I think this encourages the American way, which is spending money we don't have, living our lives on credit. And if the banks do it, then why wouldn't the consumers do it? In just 7 years, as you can see from the graph on the right side of this slide, banks doubled the amount of money and debt in the economy. So on paper, it may seem like they're getting rich, but really they only have 10% in actual cash of the money they're making at any given time. So if it ever gets to a point for some reason where people can't pay back their loans, their mortgages to the bank, that's when the bubble bursts and shit really hits the fan. So we'll examine how banks were spending this money on the next slide. On this slide, we see a breakdown percentage-wise of how banks were spending their money up to the 2008 recession. Now, banks were loaning out their money in stupid ways. Why? Well, first of all, they're loaning out the majority of their money to real estate, meaning they're giving out a lot of mortgages. And a lot of those mortgages were subprime mortgages. And a subprime loan is a loan to someone with a credit score of less than 600, bad credit. So I don't know what was going on in the bank's minds, really, if they just weren't doing their homework on the people they were giving out these loans, but they were giving out these subprime mortgages to people well beyond their means who could not afford to be paying them back every month. Why would a bank be giving out a multi-million-dollar mortgage to people with extremely bad credit? And if the bank is then giving out 30% of their loans to the financial sector, who has a lot of investment in property, and then things eventually catch up to the people who took out those mortgages and they're unable to pay back those mortgages, then homes all over the country start being turned back to the banks, start being foreclosed because people are defaulting on their mortgages. The homes on the market skyrockets, the price of homes fall. Financial institutions who invested in property, these investments are then going to be virtually worthless, and the banks won't lend because they just lost a significant amount of money with all the defaults. The housing bubble blows up, and that's when shit hits the fan. over time, debts become unpayable, and this is when the recession hits. I think what was going on in the banks is they were operating well beyond their means, just as the majority of these Americans were. They, in their minds, for some reason, they were thinking that people who were taking out these multi-million-dollar mortgages to live in these mansions, who obviously couldn't afford them, are somehow going to be able to pay them back. But obviously, that's not the case. And once, people start defaulting on all these homes, then it just skyrockets the amount of homes on the market. Prices drop significantly, and these homes are virtually worthless, and the bank loses millions and millions of dollars. The aftermath of the 2008 recession was the government ended up spending $700 billion of taxpayer money to bail out banks after a recession. In the short run, the economy is going to shrink substantially because banks are less keen to lend since the recession is fresh in their minds. But over time, the banks are going to start lending more and more, and why would they do anything different if they know that the Fed is going to bail them out? And I think the issue is here, we're not learning anything from the history of the banking system in the U.S. and what leads to recessions in the first place. Now, what would I have done? Well, it's hard to say whether I would have bailed out the banks or not, because if I didn't, in the short run, the effects would have been devastating. But I think in the long run, the market would have worked itself out. And to answer this question, I really look towards the Austrian school of thought, and Hayek in particular, where he would cut tax and regulations and reduce the role of banks as an intermediary between banks and investors to increase stability. So basically lessening the power of the Fed. And how do you do this without totally changing our banking system? Is you require banks to hold more reserves so they're not operating well past their means. Because when this ends up happening, what we do is the Fed bails us out, the Fed induces quantitative easing, puts more money into the banking system, prices are going to increase, inflation is going to increase, they're going to lower interest rates, and money is going to, the US dollar is going to lose more and more value, and our economy is going to shrink substantially. So we need a big change in how we look at our banking system, and I think the best thing to do right now is require banks to hold more reserves. That's how we'll ultimately get out of this fractional reserve banking system, which is really destroying our economy.